In every generation, investors believe they've found the next big thing. Dot coms, real estate, crypto, AI. Each time, the narrative seems relatively new and unstoppable. But despite the hype, almost every bubble in history follows the exact same 5 steps. The names change, but the human behavior is the same. To understand why markets boom and why they crash, you need to understand this 5 stage anatomy of a financial bubble. I'm going to break it down in this video so you know when you see it. Hi there, this is the Value Investor. I help people save and invest intelligently. So, the first thing that happens when you have a bubble is called displacement. And this is the spark of every bubble. This 5 stage process is from a guy called Hyman Minsky. And he says in the first stage, you have something new, something groundbreaking. It could be policy, it could be trend, it could be something like crypto. It's something new, something groundbreaking that captures the attention of investors. This investment promises to change the way that people invest, promises to change or revolutionize industries or economy. You have examples like the internet, which was in the 1990s, housing deregulation, which happened in the 2000s, and crypto, which happened around 2009, 2010. It's something that catches people's attention. What begins to happen then is that displacement lays the groundwork for exponential speculation. Investors start to shift their capital into unfamiliar territory. The early excitement grows, but fundamentals are unclear. You have an asset which is doing well, but people can't really explain where the value is coming from. When this happens, risk perceptions begin to fade. Now, what I mean by that is people throw away the risk management they have been doing for years. Why? Because they have seen that this investment is doing well. So they begin to put more and more money into that stock. And this is greed taking effect. These cycles use two emotions that I've talked about in other videos: greed and fear. So it's not the hype that's dangerous, it's what comes after the hype begins that is dangerous. The second stage is the boom, and this is where the momentum builds, price is rising steadily, supported by confidence and optimism. So the first wave of investors see very strong gains, and this now starts to spread by word of mouth. News outlets catch on to it and they start covering the next big thing. So if you see the news coverage, this is what hype produces. Your next door neighbor starts talking about it. Your gym janitor tells you to jump in. Fear of missing out, FOMO, kicks in, and retail and institutional capital floods in. Valuations start to stretch beyond fundamentals and anything that's even remotely reasonable. And once institutional capital begins coming in, that really changes things, because institutional capital is quite big, it's an avalanche. So that inflates prices further and further. And what then happens is that the boom begins to feel rational until it's not. Momentum replaces analysis as the primary driver of price, and from then on you just have ridiculous valuations in the market. The third thing is euphoria kicks in, logic gives way to mania. And what I mean when I say mania is now just people throwing their money into the market without doing any kind of fundamental analysis. So price skyrocket far beyond any reasonable valuation. Everyone from cab drivers to CEO is talking about it, and they always say this time is different. And this is what tells you that that euphoria, that bubble is now maturing. Fundamentals are ignored, risk is dismissed, leverage increases, speculation replaces investing, skeptics are ridiculed, dismissed, leverage increases, people go and borrow to actually invest in that, whatever that is, and that actually pushes prices further up. At the peak of euphoria, danger is highest, yet it feels invisible. So the seeds of collapse are sown in the confidence of the crowd. And when this happens, always know that a crash is very, very close. Number four, profit taking. So the smart money pulls out. Whilst everyone is enjoying the gains, and some people are actually starting to get in at this point, early investors begin to quietly sell. Valuations now appear quite unsustainable to those who are paying attention. To those who are not, they've been caught up in the hype, they've been caught up in the euphoria, they're no longer looking at the valuations, they're now just hyping the stocks further, telling their next door neighbor to buy, and selling their house so that they can catch the next wave of returns. Market sentiment begins to show small cracks around this time, because obviously the smart money institutions are starting to pull out because they are seeing that the valuations are no longer making sense. Number five, there's a panic. The bubble bursts. This is really sad because the people who are mostly caught up in this panic stage are the simple investors who don't know much about valuation. And sometimes even the very smart investors can be caught up in this, because it's human beings are human beings, and they're going to do what human beings do, and human beings get greedy. And what happens, if you look at the subprime mortgage crisis of 2008, it was mostly the institutional investors that were caught in that thing. So panic sets in, the bubble bursts. A trigger event like the increase of interest rates, bad earnings, fraud, things like that, it shatters the confidence of the market, and price starts falling, and it starts falling very fast. And when this happens, especially with the algo trading in the market right now, selling often triggers more selling, because what happens is that, especially the index funds, when the market starts going down, they need to sell to be able to keep up with the allocations or weightings of their stocks in the market, and this triggers more selling, which triggers even more selling. So price start falling fast, selling accelerates. The media, which was hyping up these stocks, it flips from cheerleading to fear mongering. So it's quite interesting because investors are rushing to exit, but there are a few buyers left who are still buying, still thinking that they are buying the dip, like they call it. So we begin to have margin calls in this phase, and margin calls are those people who were buying using leverage. They begin to be told by their broker to deposit more money. So faith in the asset and the narrative just totally collapses. People have lost trust in the system. They have completely zoned out, and some of the people that are actually caught in these market crashes will usually not return to invest in the stock market for a very long time. So this is the thing, every bubble tells the same story, but with different characters. A boom starts with innovation, but it ends with excess. So this has been the story of time, from tulips to tech to tokens to NFTs. Human behavior doesn't change. Recognizing the five stages isn't just history, it's self defense. You remember the South Sea Company, which grew 800% in a year without earnings. If Isaac Newton was alive and you wanted to talk about this company to Isaac Newton, he'd probably give you a slap. he was caught in this bubble and he lost a lot of money. So we see this happening now to AI stocks. There's a lot of hype, a lot of people going in, and there are some companies which are making real profits, but sometimes even those companies might have valuations that are detached from reality as this bubble progresses and continues to grow. So only time will tell how this AI thing, AI bubble will end. But this is me. If you've enjoyed this video, please give us a like, share it with your friend who is caught up in the market hypes, just to remind them to take it easy. Share this video and please subscribe to the channel. It helps people to discover our videos, and I will see you in the next one. Cheers.